Hello, and welcome to the ConsistentOptionsIncome.com Pairs Trading Course, Lesson Number 3, How to Find Pairs to Trade. Let's get started. Okay, here are some criteria that will help you pick pairs that have a better chance of being profitable as trading vehicles. The first one is no ADRs. ADRs are American Depository Receipts. Essentially, they're foreign stocks that trade on U.S. exchanges. So we generally want to avoid these kinds of stocks because since they are foreign stocks, they are vulnerable to the fluctuations in currency. So we just don't want to have that risk on one side of our pair, let's say. Also, the more volume that a stock has, the easier it's going to be able to trade. So we want high volume stocks, but we also have to balance that with finding enough stocks to trade. We want a lot of opportunities for pairs trades, and we want to see those opportunities every day, so we can't limit ourselves too much by having a really high threshold for volume. So a good rule of thumb is around 300,000 shares on average traded per day, and that should be a pretty good starting point. You can raise that value if it makes you feel more comfortable. Also, we want to pair stocks that are in similar industries. We want to avoid stocks that are in volatile industries. For example, biotech can be very volatile. You know, you could enter a pair in two biotech companies that you think are in basically the same business. They have very similar drugs. However, all of a sudden, then one of the biotech companies gets approval from the FDA for, let's say, a cancer drug or something. All of a sudden, in a heartbeat, that company is now in a different business than the other company that you paired it with originally. So we want to try to eliminate this kind of volatility from our trading. Another good one would be, oil exploration companies. Two companies have a certain number of wells, and all of a sudden one of these companies finds a really big deposit of oil. All of a sudden now their prospects look a lot better than the company that you had paired them with originally, and now the historical relationship is skewed. Also, we want to find stocks that are in similar businesses, fundamentally similar businesses. Not just the industry or sector, but we want to look at them a little bit more in detail and make sure that they're really doing the same kind of things. For example, we use Pepsi and Coke a lot in examples because it's easy to understand. They both sell soda. However, Pepsi also has a food division. So it really isn't in the same exact business as Coke. It has an additional food division. So on a fundamental basis, they're probably not similar businesses. And in fact, when you get to the next step, which is more mathematical, looking at the charts and the past trading experience, these two companies will probably get kicked out because they don't behave in a similar manner. So the next item is that we want to calculate correlation and co-integration. Now, correlation is a pretty easy number to come up with. You can put that in a spreadsheet, but we are more concerned with co-integration. Co-integration essentially means that these stocks will travel in a way where they will depart in their pattern, but will also revert to the mean of the relationship. And so we want to assess that on a mathematical value because it's kind of hard to do visually or just doing fundamental analysis on the companies. So one of the tips here is you want to avoid the augmented Dickey-Fuller test. You'll see a lot of websites out there that will have a number for the co-integration. And if you see a single number for co-integration, you can almost bet that it is the augmented Dickey-Fuller test. Now, that test, there's really nothing necessarily wrong with it, but really all it's telling you is the probability of whether a pair is co-integrated or not. So we want to do better than that. We want to know if it's co-integrated, not just whether it has a chance of being co-integrated. So finding the true co-integration is much more difficult, and this is where our alert service can add value. We go through the co-integration process and evaluate all the different pairs that we've put together. We make sure that they have been co-integrated and that they continue to be co-integrated moving forward. Also, we want to visually inspect the pairs to ensure that they don't spread too much historically. So this is kind of an additional test to just have a common sense look at two charts and say, yeah, they're kind of similar in their behavior. A lot of times you can do the mathematics and you can sort of do the fundamental analysis, but then when you actually look at the charts, you go, no, they're really not very similar. So we want to put as much on our side up front making sure that we're trading the right pairs before we get into trades and find out the hard way that stocks aren't necessarily paired very well for pairs trading. So these are a few tips, things that you can do on your own to find good pairs to trade. We hope that if you spend some time thinking about this, that you will see that all the drudgery and grunt work that our alert service does for you presents a good value. If you have any questions about this video or any of the content, you can contact me at john@consistentoptionsincome.com. You can also check our website for more information. And coming up next, Lesson 4, Filtering Pairs to Trade.